Good Sunday morning, ITG members. Welcome to the October end of month update. I'm excited to walk through the market's performance over the last 2 weeks with some insights into what we might expect going into November. October brought some surprises, and while there were challenges, the broader market continues to show resilience in the face of weakening data. Before diving into the details, here's a quick roadmap for today's video. First, we'll review the PVI system, explore sector-specific performance, take a brief look at mid-October game plan, and close with a look ahead at the key events on the horizon, including election-related impacts. So let's get started. Let's revisit our PVI model ranges. For those newer to ITG, the PVI system integrates 26 models to give us weekly ranges for the SPX. Each model outputs a high and low for the week, and after scrubbing the data across the models, VET is able to calculate a final PVI strike, which ITG members sell 100 wide credit spreads at. The key things to be on the lookout for are the largest number of models clustered in a tight area, as well as any significant outliers. For this week, the PVI strikes were 5,581 on the low side and 6,032 on the high side. There weren't any significant outliers within the initial nodes on either side, which often is an easy debit spread play to either one or both sides. There were also singular models pointing to the 2 times expected move on both the high and the low, but neither of which was a concern for us heading into the week. We did see the highest nodes on the lower weekly ranges hold firm at around 5,700 to 5,720, while the lowest node on the high side was never tested at 5,880. The PVI model ranges help us visualize where the models are pointing to areas of confluence, and in this case, we move to using the PWG levels on TradingView to actually trade futures. The PWG levels, which stands for Private Wealth Group, are calculated levels that act as areas of support and resistance and are essential for hedging any PVI trades that are placed. We have other videos on the Indie Traders Guild website that help explain more in-depth the ways to use the PWG levels for futures scalping, but also how to hedge effectively if in PVI. For this past week, SPX remained relatively range-bound from Monday until Wednesday. There was a gap higher on Monday as the futures market pushed higher in Globex, and that gap wasn't filled until early in the Tuesday session. While price did break out of the weekly supply-demand box, it was a look and fail, and the afternoon session on Wednesday saw the markets push back into the zone between weekly supply and weekly demand. The major tech earnings of Microsoft and Meta pushed price lower overnight, and Thursday opened with a major gap down. The overnight selling pressure from tech was too much for any significant intraday reversion, as most major indexes finished down 2% or more on the day. There were also the mechanics of the JPM collar roll at play, with one of the smaller funds rolling into the afternoon session on Thursday. However, 2 straight weeks of losses isn't really sufficient to claim that trends have turned down, and while price pulled back, it moved to levels right above this past summer's peaks in the September support zone. There was a good bounce on Friday out of that lower demand zone and saw a roughly 50% retrace of the prior sell-off move. SPX finished the week having put in a low at weekly sell target 2. We have mentioned before that weekly buy target 2 and weekly sell target 2 tend to cap price action on more range-bound weeks, and that happened this week. As we move into the last weeks of October, it's helpful to review our initial roadmap for the month. Here were the key areas we were monitoring closely: SPX model ranges. We were closely watching if the SPX would reach resistance at the 5,855 to 5,900 range. This was our benchmark for gauging the upper bounds of market strength and potential points of reversal. Sector rotation. The plan was to monitor continued strength in financials, industrials, and consumer discretionary as these sectors were leading the market. Technology had been lagging, but we anticipated a potential catch-up if momentum shifted in its favor. QQQ resistance. For the NASDAQ, the goal was to see if QQQ could rally toward the 500 to 505 level, and whether it would encounter resistance or manage to break through. Breadth improvement. Another area of focus was the participation across the broader market. Specifically, we wanted to see if the equal-weighted SPX/SPX-EW would continue its outperformance, signaling stronger market breadth and participation. Volatility expectations. With VIX signaling uncertainty in mid-October, we prepared for a potential increase in volatility. Finally, we anticipated a potential consolidation period, as late October typically brings a bearish seasonal trend. This was about watching for signs of the market either consolidating or maintaining its upward momentum as we move toward November. Let's look specifically at the weekly performance across the major sectors. We saw some interesting shifts, with communications and financials showing resilience, while sectors like real estate and utilities continued to struggle. Technology, which had been lagging, saw a slight improvement, but remains under pressure relative to other sectors. To me, this setup suggests that sector rotation remains a dominant theme, with capital moving out of defensive sectors and more broadly into growth areas, though we're still seeing caution around technology. In terms of that caution with tech, the QQQ resistance levels and how this affected the broader market. QQQ approached key resistance just over the 500 mark, but hit a wall. We saw strong moves from megacap names like Microsoft, Apple, and Nvidia, but eventually they began to pull back into late October and into earnings. The equal-weighted SPX ETF represented by RSP has shown clear underperformance relative to SPX the past 2 weeks, with large-cap names temporarily holding up the market. However, as the Mag 7 started to lose steam, we saw more uniform selling across both large-cap and mid-cap stocks, and that becomes clear when we look at the SPX in comparison to market breadth indicators, specifically the percentage of S&P 500 stocks above their 50-day, 100-day, and 200-day moving averages. The last 2 weeks saw a third of the S&P 500 companies move below their 50-day moving averages. This decline in breadth is a warning sign. While SPX itself remains elevated, the underlying strength is fading, meaning that fewer stocks are participating in the rally. The last time there was this sudden shift in momentum was back in August when the market sold off 5 to 10%, so there's always the possibility for a move lower before new all-time highs. As we look ahead, November could bring a mix of consolidation and potential rallies. I do expect some short-term pullbacks post-election, but overall the long-term trend remains constructive. I'll be closely watching SPX resistance at that 5,900 to 5,935 zone, and keeping an eye on QQQ resistance around 503 to 505 if it were to make another push higher in November. Given the resilience we've seen, I believe the fundamentals are strong, but we should stay cautious as high sentiment levels and deteriorating breadth could bring unexpected volatility. With the U.S. election right around the corner, we're seeing high early voting turnout, especially in the 5 swing states. The fact the race is close will likely add volatility to the markets, with impacts potentially extending beyond November 5th without a clear winner on election night. In the Senate, it's starting to tilt toward Republican control, with key races in Montana and West Virginia being closely watched. The House is still up for grabs, and its outcome will likely be more influenced by the presidential results and fewer split-down ballot races. In terms of economic data, the first data point is on Tuesday with the ISM Services PMI for October. This report is important because it provides insight into the health of the U.S. services sector. A drop might signal some slowing in service activity, while a surprise to the upside could reinforce growth expectations. On Wednesday morning, we have the S&P Global Services PMI, another measure of the services sector's performance. Moving to Thursday, we'll see the non-farm productivity report for the third quarter. The market is expecting a 2.3% increase, slightly below the previous quarter's 2.5% rise. Productivity gains are critical because they help offset inflation pressures in a tight labor market, so a strong reading here could be positive for the broader inflation outlook, especially given last week's NFP jobs report. At the same time, we'll get a look at unit labor costs for Q3. This is a key measure of wage-driven inflation, and if labor costs are rising faster than expected, it could increase concerns over inflation going into 2025. Finally, Thursday afternoon brings us the FOMC rate decision. The market is anticipating a potential rate cut to bring the range down to 4.50% to 4.75%, from the current 4.75% to 5.0%, a 25 basis point move. However, the Fed's tone and any hints on future policy moves will be crucial here, especially given the recent economic data and the election results. And that's the quick recap of the past week and what I'm expecting heading into early next week. Thanks for tuning in. As always, I encourage you to stay connected with us for more insights and updates throughout the week. You can follow us on social media to stay in the loop, find us on Twitter at Indie Traders Guild, subscribe to our YouTube channel for deeper dives and analysis, and check out our website, indietradersguild.com, for articles and resources specifically for new traders. And of course, if you're not already a part of it, join us on Reddit, where you can engage directly with the community and participate in some of our weekly discussions. Let's keep our positive momentum going as we move through Q4. Thanks again, everyone. We will see you next time. Enjoy your Sunday. Take care.